Hey, what's up, guys? Welcome to the About Real Estate podcast. Today we got special guest James Tran, and we're going to talk about real estate investing and valuation. Coming from a background, James is an appraiser, investor, and a realtor. And we're going to talk about how he got started, how's everything going, and what's his future plans. So to introduce James, James has been in the commercial real estate since 2005. Man, he's been honing his expertise in property valuations, appraisals, sales, and investing. As the CEO of JT Real Estate Services, James has become an experienced negotiator and veteran real estate analyst, having participated in real estate deals with values up to 40 million. He also serves as an investment advisor and consults and partners with his clients in real estate investing deals. So we're excited to have you on, James, and learn more.
Hey, thanks for having me, Matthew. I'm excited to be here.
Cool. Tell us about yourself. How did you get started in real estate?
So I started in real estate in undergrad. I actually interned for a real estate developer, and we were talking about earlier syndications. They were syndicating large apartment deals, 200, 300 unit deals in Southern California, Arizona, and Texas. I got started on their marketing team. I was picking up calls. They put out radio ads for the homes that they were selling. So they took these large 200, 300 unit complexes and converted them to condos. They're doing condo conversions, and I was responding to potential home buyers as their calls would flood in after these ads. So that was my first exposure into real estate, really, and from what I saw happen at that company, and all the money that was being made and how fun everything was. That's when I got hooked and decided to head towards real estate. Mm-hmm.
Nice. So what made you, from going to that route and going to marketing, what made you decide to become a appraiser?
Actually, the CEO and the COO of that real estate development company, they were former appraisers for 20, 30 years. And so I decided to follow in their footsteps. I decided I was going to become an appraiser in order to learn all the valuation techniques for every type of property to equip me in the future for, when I was ready to start investing myself. Yeah.
That's a good way to put it too, because being a real estate agent versus being an appraiser are completely not exactly the same. We don't always see eye to eye in terms of like appraisal values versus sales values and current market of people overbidding. It doesn't always align,
Yeah.
So that's tricky. And as an agent, like, hey, come on, appraiser, raise the price up because this is what the market's paying. But you have to justify that too. How does that compare to the market, right?
Yeah, exactly. I see both sides of the coin. On the appraisal side, I only do commercial, so I'll do multifamily, 5 units and up, occasional fourplex, but so that's the angle that I'm working on. So I'm not dealing so much with the residential side where you're seeing all this overbidding happening.
Yeah.
I could definitely, when I'm working with clients, still empathize with the appraiser and what they're trying to find comps to justify this number, and trying to cover themselves and make sure they're doing everything by the book. At the same time, if I were in their shoes, know that the market's just growing. It's getting crazy, and in a rising market, it's hard to find comps, and you're looking backwards to support a current purchase price sometimes.
So how do you justify that value? And even for commercial real estate, 5+ units, how do you guys justify the values?
So it really depends on the property type. So if we're talking multifamily, like 5+ units, that's it all starts with who's going to buy that property, the most probable buyer, and it's going to be an investor. So how do they justify the value? As appraisers, we're mirroring the most probable buyer and the techniques that they're using. So for an apartment, we would it's all about the rents and the income, and so rents minus expenses and applying a cap rate. That'd be the primary way for that. But if we're looking at a industrial building that's vacant in Southern California, a smaller one, the most probable buyer in that case is the owner user. So we're going to be valuing that one similar to how we value a single family residence with comparable sales. So it's like a different hat for every type of property, and whether it's leased or not leased, always changes. Yeah.
That's actually a good thing too, because for example, you know how you mentioned the background of developers being appraisers and then going into syndications is kind of cool because you have a different kind of eye in seeing these properties, values, knowing the numbers, and also because you analyze so many properties in specific areas that you can say, hey, this is actually a good deal. This is why it makes sense. This is how we can underwrite it, and this is how we could potentially purchase it and resell it, or add value to the property. So it's kind of nice to see that too, and you have a different perspective. Like for me, I came in as a background as first starting buying real estate when I was 24 in San Francisco. Then I became an agent, and then I became a lender, and then 1031 exchanges. I utilized those kind of services. I never got into appraisals. I like it, but I was like, just different kind of animal. I'd rather just stay on the side of things. But it's good to have different perspectives to buy real estate and invest. And being at the forefront the most is actually advantageous to help ourselves, to help our clients to do that. So you created your company too, right? It's called JT Real Estate Services.
Yep. Yeah.
So you I guess you had, was that a brokerage as well before?
Oh, what was that?
Was that a brokerage as well?
Yeah. So it's full service real estate company. It started off as a brokerage and appraisal company, and now my license is hung with EXP. I'm a broker associate there. Maybe started with them October of last year after seeing what they had to offer, and it's a lot of administrative stuff to keep up with when running your own brokerage. So decided to offload that and benefit from all EXP has to offer.
Nice. Yeah, it's a great way to kind of get rid of your, your workers' comp liabilities and focus on being a broker associate and running a team and going global, right? It's an easier way to do it rather than doing everything yourself because you can focus back on your clientele, your primary services, rather than on the back end operations of things. I like that too because I ran my own brokerage as well, and it was just so much easier now. So it's a lot of fun.
Yeah.
So right now you're in Pasadena right now, right?
Yep. Yeah.
Where do you guys primarily invest in?
So I wouldn't say I had a primary space. I've done some flips out of state in Oklahoma. I've flipped here locally in Southern California, and had some small multi in Southern California as well, and now invested in Columbus, Ohio. Got a portfolio out there of apartments, but so I'm kind of all over the place. Wherever there's an opportunity, and yeah.
Let's talk about that too, because you know how you look at opportunities. So it's not location specific; it's property specific, opportunity specific, which is great. How did you come along going from those different types, like small homes, multifamilies, to going to a big multi-unit in Columbus? How did that all get started?
Yeah. So all along from the beginning, I knew that I was going to be an investor. It's the whole reason I got into an appraisal. So at a certain point, it did take a lot of courage to build up to start doing that first deal. And my first property was a fourplex here in a town called San Pedro. It's a part of Los Angeles. And kind of cut my teeth on that property. Owned that for 3-4 years. I had it was like a Class C type of area and property. So I had the Section 8 tenants. I had drug dealers, and I got that experience as self-managing as well. The property was 45 minutes away from me, but I found that it took a lot of energy, even though it's just 4 units. But I think I was at the time I was working full time as an appraiser. I was actually doing like 80 to 100 hour a week, so it was just intense. And I decided to, after 2 years of getting that self-management experience and that exposure, I offloaded that to a management company. And I think during that time, I got a little sidetracked. The flipping shows came on TV, and it started appealing to me. I'm like, hey, why don't I try one of these? And actually, some opportunities came up out of state in Oklahoma with my my sister's ex-boyfriend at the time. So his uncle lived out there, and there were some deals that came about, and he asked us if we wanted to go in on them. So I was like, sure. I actually, this is during a stint of time, I left the appraisal company I was with, and I flew out there and was doing everything with our hands. I was removing wallpaper, painting, all that stuff, just to get that ground up experience. That That's pretty cool.
It's a lot of hard work. It's harder than it seems. You know, it looks easy, but just a lot of energy to do it, right?
Yeah, yeah, and it gave me like an appreciation for contractors and what goes into that. But I think that experience really it helped me to see the price of everything and what how much effort really goes into doing different parts of a renovation. So when you're pricing things out now, you get a better idea if you're getting like overcharged or not by a contractor.
Yeah, it's definitely a great skill to have, especially like when I started physically remodeling houses. That was a lot of work. I was like, damn, this like it hurts, it stinks, it's dirty, and I have to take a shower every single minute after this. And it is, but it's rewarding to know how like now you know exactly material costs, labor costs, time, intensity, values, and is it worth it? And at the end of the day, when you sell it, does it make money? And you learn a lot from that too. So you start appreciating, and then you start seeing how good handyman workers are, contractors are, how quality they are, or what they actually miss and don't tell you, don't do, how they cheapen things sometimes, or how good
Right.
quality they are and how accurate they are, right? Some guys are super meticulous, like, wow, you did it that way. You had lasers and everything and you're perfectly aligned and like, nice, I like that. And some guys just charge an arm and leg for nothing because they just try to market their services, right?
Yeah.
So you get to learn from all the sides of it and you appreciate it more and you know who to work with, and having a great team makes is the hardest part to find. Once you find the team, keep rewarding them, helping them, and growing together, right?
Right.
So you went to Oklahoma, okay? And how was that? Those fix and flips, like how did it turn out?
They're good. I mean, these were smaller properties. At the time you can buy them for anywhere from like $30,000 to $50,000.
That's like a bathroom here.
Yeah, right. Yeah, those are smaller flips. You can make like 30, 40, maybe 50,000 on a flip over there if you're lucky. But yeah, that market, it's the market that doesn't really appreciate, right? You can buy a home out there, a single family home, and you can get 15% cash on cash return. But the value of the property is just over like 10 years, it just barely moves. So so after the experience over there, I shifted my focus back to the fourplex I had here, and I'm like, okay, I need to go bigger. I need to really start pushing myself here. So I decided to sell that fourplex, and I did a 1031 exchange, and actually, so this apartment complex I have over in Columbus, it's 70 units. It consists of 4 properties along the same street. It's a portfolio, and so I'm 50-50 with a partner, so joint venture. This is actually a guy that I went to high school with, and I ran into him on Bigger Pockets. So it was
Nice.
yeah, it was like kind of this timing, and she did some flips together, and decided to he flipped. So the equity I built up in this fourplex, about 400 grand over the course of 4 years. He flipped a duplex down here in a city called Glendale, and he's able to come out with the same amount of capital. Crazy. So yeah, we went 1031 into this 70 unit complex together, and
Good.
yeah, that comfort was already there going out of state with the Oklahoma, the flips, and the valuation part. I was really comfortable with that. So I was just like, okay, let's do it. We know the cash flows out there in the Midwest. Yeah, it comes with its own challenges going out of state, which you can cut your teeth doing that first
Well, let's
time.
talk about that too. So, for example, you have fix and flips, you have a 4 unit, and you 1031 exchange to a 70 unit. That's
Mhm.
each of these are individually different, right? And it's kind of challenging and rewarding. So, based on experience, for example, when you do a fix and flip, you're putting a lot of sweat equity into it. You're remodeling yourselves, you're working with people, you're trying to add value into a property, and you're trying to do it really quickly. And at that price point, you mentioned 30K, you probably need to do like 5 at a time, right? Rather than just one, you're doing like 5 at a time, and you're trying to build equity into it, force equity, right?
Yeah.
On a 4 unit, you got it. You had some Section 8, some difficult tenants, and now you're trying to add value over time, add value through appreciation, hopefully some remodeling work and raising rents to market rates. But it's a different kind of skill, different kind of timing and values, right? But to
Right.
be able to exchange that into a 70 unit And even with partnership, that's really good because going from 4 to 70 are not the same. 4 and 70 are by far different. And doing it out of state as well is another challenge you're adding to it.
Yeah. Yeah.
So what kind of complexity goes into all these 3 different types that you see?
So, so yeah, I thought we were well ready for the 70 unit with all the different types of experience that we garnered in the past. But the challenge was on the 70 unit was really getting a good property manager. We ended up with after interviewing like 5 different property managers. These are all referrals from either the broker we're working with or other people in town that had property there. And after interviewing all of them, we decided to go with one. And this property manager, he didn't do quite the stellar job. This cost us a lot of money, and the big lesson I learned with this property manager was pretty much fire sooner than later.
Yeah.
The property management contract we had with him was structured in such a way that he had an advantage. He collected fees for collected all our late fees for when he put the tenant in, fees for evicting a tenant. So there was just a structure that encouraged churning of the units. Put an unqualified tenant in, collect that fee. A couple months later, stop paying, evict them, and just a cycle. It took a little bit longer than it should have for us to catch on to that. And even when we did, we flew over there. We're like, we're gonna put his head on the chopping block. We're gonna get rid of this guy.
Yeah.
And then he's just such a talker that he like sold us into like, give me another chance. So this went on for a few more months, and it's the big lesson there. Just lost a lot of money in the first year and a half sticking around with that management company.
Yeah, you gotta fire fast. And I think for me, like I try to take the emotion sides out of things. I look at the financials. Basically, you just do an audit analysis on the P&Ls and you look at how everything's running, and then you look at your contracts and you see who's advantageous for property manager or the owner. It should really be win-win, right? Like everything we do is together. We win-win together. It's not one-sided. And if it is one-sided, don't work with them. And there are some good property managers, even in Columbus, Ohio. I actually know some I can refer you to. You can always interview with the property managers, the lenders, and everything, see if it makes sense for your buildings. But there are both sides of it, because I also am a San Francisco property manager. But it's really advantageous to my clients if you look at my contracts the way I write it, because my end goal is client user experience in investing, building portfolios together. So my property manager is only based on investing with them to grow together, right?
Yeah.
But when you look at someone else's, like even other clients and other friends, like I feel bad for you. The way they structured it is just so crappy for the owner. They're taking advantage of you. Like, why are they charging all these fees back and front? And then you look at the expenses, they're increasing cost on things that are like, hey, just for example, change this knob, change this thing, $150. Like, dude, that's like 10 minutes. I know you got to drive there and buy it, but at the same time, you're really charging this and you're going multiple trips, doesn't make sense, right? So when you're doing 70 units, it's a different approach, but you still look at the financials and see like how are they managing the building, right? And how are they trying to help you optimize building, increase your value, right? Yeah. But jumping into a 70 unit from a 4 unit is so different. And how do you guys handle, even with a property manager, how do you guys handle the 70 units? How did the property manager manage the units, the leases, the vacancy control, the financials? So you guys are just becoming more of asset manager.
Yeah. So this first management company we went with is more of a mom and pop type operation. We get our report once a month, but initially when we just bought the property, the first like 6 months we were getting our distribution. So kind of took taking responsibility, took my eye off the ball, and wasn't monitoring the numbers, which is another thing that lesson learned from this. So we'd only hear when there was something something wrong with the property, or he needed us to make a decision on some large expense, which after the first like 6 months they started happening a lot.
Yeah.
The current management company that we're with now, I think is probably more representative of how our property management company should operate. There's a regional manager. We have a on-site manager. So it's broken down into different tiers instead of a one-man show. And I don't know how the other guy kept up with everything managing.
They can't. There's no way. There's no way.
Yeah, you call him for like everything. I'm like, how are you even like having time to get new business? So this new company we're with, we have our weekly calls. We're looking at metrics, occupancy, we're looking at the collections, delinquency, and just going over set points every week, so we can keep an eye on the property, and before anything slips, for like a certain, like for example, like the water bill. There's been leaks at the property where the bill's been like gone sky high, but being able to monitor these numbers during our weekly meetings and look at these, we're able to catch that stuff before we lose more money.
Nice.
So, yeah,
that is the best way to do it, because like when you start, like, this is an investment now, right? It's not just a property. It's not just 70 units. It's 70 families there, for example. But at the same time, you're trying to figure out as an owner how to optimize the building, increase values, reduce expenses, and for example, adding rubs, your utilities, right, services, chargebacks, and then any capital improvements and pass-throughs, and just adding value to the unit itself, and just slowly turning them as you need to increase it and get to a good performance number where they're still skin in the game for the next person. But for your ability as investors, like, how do I scale to the next one, right? How do I get from 70 to 100 units? Or how do I take this cash flow and put it into another building nearby or in another state? So like, how quickly can you do that? Because if you take this, even though it's a partnership to you guys together, how do you bring this model into like a syndication model where you can go to another one, and use this experience to justify the next property you're going to jump into, right?
Right.
It's always learning. Like everyone, even if you've been in business 60 years, you're still going to learn every day, and every property is different.
Oh yeah.
Yeah. And in Columbus, is your roof like a flat roof, a sloped roof, or how is that in each building? Buildings.
We have flat roofs on all of them. Yeah.
Have you guys experienced snow for that one yet?
Snow? Yeah. No. Yeah.
And how did the roofs hold up for that year?
Well, as far as I know, they're still there.
Yeah.
Yeah.
Yeah, because I was looking into that. When I was looking at Columbus, and I'm actually born in Columbus, so I kind of familiar with some parts of it still. But yeah, I was like looking at that. I was like, okay, I see some roofs. Most of them should be like this, but they're like flat. I'm like, how's that going to handle the snow and like all the water, and how are they managing it? But it's good to see. What area of Columbus are you in?
Some grading there. Northeast Columbus. So
okay, Northeast Columbus.
There's C minus D area. So more prostitutes and drug dealers, right?
Hopefully you can turn it around. I think of one good example. One of these big investors in the Bay Area mentioned to me, because if you think about it, and these homes, if you can build in the future, they're talking about like big scale, right? Not small scale. They're like, if you think about this like Monopoly, and you start you say you like areas for a specific reason, and you start increasing values and buying properties in those areas, you can change the model, you can change the economics, right? At a high level, you can do it. I'm like, yeah, because you have hundreds of millions of dollars. We don't, right? We can't do that at a small scale. I get it. That's kind of smart and nice, because they started bringing in communities. Like they brought in the restaurants, they brought in all the shops, they brought in shopping malls, they brought in multi-units, and then you see the values drive up. I'm like, yeah, you brought in the whole town, so of course that would make sense. But if we're buying one property, that's completely different. Why don't you just tell us about the property and we'll go buy with you?
Yeah. No, I thought about that same thing for this portfolio, because it's in an area it's not so great of an area. There's not a lot of like good retail. You don't have like Starbucks in this area. And I was just really thinking, like, how do you really change this area to increase the value? Because the idea definitely crossed my mind, like how to do the value add, but I just didn't see like tenants paying another like $100, $200 here for granite countertops or like newly renovated like bathrooms. So it was like, how do you bring how do you change the area so that those type of tenants start coming into town? And yeah, I think it does start with the retail and the amenities in the area, bringing those people in, large grocers, name brand grocers. And what really drives, pulls the population into this area. But if you don't have that, it's like, well, why would they want to move there first? So yeah, I think you definitely need a lot of money to change an area and bring it up.
Yeah, I was actually talking to my cousin about that because he actually owns shopping complexes in Columbus, Ohio. So it's like,
Oh.
okay, well, if I buy a multi-unit in this area nearby, let's talk to you and your friends about putting up restaurants, malls, and businesses, doctors, dentists, lawyers in the same complex, and make this work. So that way, you create a small local community next door to the multi-unit.
Mm-hmm.
And then start increasing the community space for them, make it more affordable, make it fun, and create business for each other, right? Like that makes sense, and like his numbers are astounding. Like I think it was like, how you have 1% rule. I think his is on 2% rule based on shopping complexes, but it's only because he already had the connections to occupy all the units right away.
Okay.
So then without that, it'd be less than 1%, right? Because you don't
Yeah.
have those businesses who can afford it right off the bat.
Right.
Jumping in makes it so much easier and I think they're doing like restaurants, they're doing insurance companies and other businesses, but it's really good returns on their end.
Yeah. Shopping malls definitely a different animal in themselves. Like how you create value with those, having the right mixture of tenants. They all have to be synergistic, right? Like you usually see a donut shop right next to a laundromat a lot of times, or you start seeing the same type of nail salon in these shopping centers. Have the same services, and they all draw on each other's traffic in such a way. So having the right mixture, make sure you don't pull in like I don't know, like a cannabis store, like that ends up like killing the whole vibe of it.
Yeah, I see that example in Richmond district of San Francisco. There's a cannabis store next door to a preschool. I'm like, I feel bad for that preschool. They were there first. They didn't know next door would put a cannabis shop, and now I don't see anyone there anymore. I'm like, I feel bad for you. That's wasn't meant to be that way, right? But separate buildings, so I get it. You can do whatever you want. But yeah, in shopping complexes, you can create synergy and create alignment with different brands and businesses that work together and just join in together. If you can find an open space to do that near your multi-unit, that'd be really cool.
Yeah.
So how does it feel now? Like how long have you guys owned that 70 unit?
It's been 3 years.
3
Yeah.
years? How's it been going? Like I know the first part of it a little hard to get started because you're always trying to figure everything out and get onboarded to the building and get acquainted with everyone. But how's on year 3 now? How's it performing?
So yeah, right before the pandemic, we finally hit our stride, and we'd locked in this new management company. The systems were in, everything was going well, and then the pandemic hit. I'm like, oh shit! Like, and then of course, tenants had trouble paying rent. Actually, towards I think the third quarter is when we started seeing it more. Because initially, I think the first round of stimulus checks kept the rent coming in, and at third quarter is when we started seeing more delinquencies. And so we're going around Ohio. You can actually get a tenant out if you can prove that they've exhausted all their resources. They have to prove that they've exhausted all their resources. But by that time, there's one resource in the eviction courts. They're called like impact. That's like a government, like a subsidized government agency. Mm-hmm. So when you're in eviction court, like the tenant, they would have to exhaust all resources. So, but that agency was there to provide them to help with the back payment. So because of that agency, we were able to kind of survive the third and fourth quarter of last year. But we're re-tenanting the building, and actually the property is we're on the verge of getting it sold.
Okay.
So
is it in contract right now?
It is, yeah.
Okay. Call me if anything changes.
Yeah, for sure.
We'll talk about it.
Yeah.
Okay, so that's good that you guys, for example, you bought it in the last 3 years, you did all this work to it, and you hopefully add a lot of value. And I'm hoping that you sell it for a great price. What are you guys gonna do after you sell it?
I haven't decided yet. We've been trying to sell the property for the last year, and pandemic hit, so there's the whole timing. So I haven't really fully decided where to 1031 the money's into. Honestly, that this experience out of state, is an eye opener for me. Before going out of state, there was actually several people that I talked to, including like a broker here in town, really experienced guy. He got his master's in real estate development from USC. But he had told me before, kind of gave me a warning before going out of town. A lot of his buddies that have done that in the past ended up back in Southern California. And I've heard this from other people, but if you kind of compare, the cash flow that you can make out there versus the appreciation you end up getting over here in Southern California, if you compare the two over a long period of time, a lot of people end up doing better, unless you're doing value add stuff. You end up doing better here in California. And there's a lot of people that speak against that. It's all about cash flow. You can't bet on appreciation.
Yeah, you can. You can bet on appreciation
over long periods of time, right? So
yeah.
I think those people are probably not in California, probably in a different area, maybe the Midwest.
Yeah.
And I'm right now. I'm thinking bring the money back to Southern California and doing more opportunistic type stuff. There's a lot of opportunity in the industrial. I think office as well, and even residential. I mean, doing things like adding like ADUs to multi-unit property, to like a triplex or a fourplex, doing that kind of thing, where in an area that I'm able to get to and manage the process easier rather than a 5-hour flight away. Really putting it on management's shoulders and trusting them. So
it's tough.
Yeah.
Because when you look at, like, for example, you look at real estate syndicators, they have to overcome these challenges all the time, and they have to really find boots on the ground in each specific area. But when you find the right team and it's performing well, there's a lot of potential to be made on these properties, and a lot of good add values, especially from the small mom and pop shops that you're helping to carry on and build up the community. And it's really great because you can actually change the community, make it so much improved, right, and improve the buildings and the space. But comparing that to local California, like I do multi-unit investing in San Francisco Bay Area, and it's great too. It's a lot of appreciation, long-term, mid-term, and it's money to be made, and that money can be way more than cash flow. But there is some good opportunities to do cash flow plus equity. Not easy. Everyone wants both. I get it. Out of state, it's mostly cash flow, but the price points are completely different. Like Ohio, you can buy like a 20 unit for $1 million. Here, you can buy nothing for $1 million. Less than a single family home, a condo maybe, right? And the numbers are completely different. But there's always ups and downs, like you said. Flying 5 hours away, 6 hours away to see something, and you can't be there to manage the property manager all the time, and you have to trust their numbers, but you have to vet them really well. And even if you vet them really well, it doesn't mean they're always watching your building, because they have so many buildings to manage. How do they manage yours at a high level, right?
Yeah.
So another option is having a team, like having a local GP on your team who is in the area. But it's also hard. Are you going to have a GP for every single city you're in, for every single property? Not really. That is a challenge. But if you're going from a 70 unit and you come back to California and you go buy 4 units and add values, 1031 exchanges, the numbers are different, right? And the vacancy factor is different. The timing is different. You have to deal with rent control, California state rent control, right? And permitting processes here are different. It's not landlord friendly state.
Yeah.
So that's something to think about too. Versus, you can also partner with other syndicators. You can JV into deals, right? With your funds, you can JV into a partnership and use your 1031 exchange as a JV partner or GP, right?
Right.
That's an option too. And just we would say you want to work with really good, experienced syndicators who have a proven track record of performing.
Yeah.
And then that would help make it easier too. But you have to see what works good for you and your business partner on that.
Yeah.
So going back and looking at a couple of things for appraisal and valuation, when you bought the 70 unit, did you use your appraisal eye and look at that versus a normal agent's CMA and like value the property? And how did you forecast it, what it would be in the past 3 years?
Yeah. So I looked at the historical operating statements for the last 2-3 years, and approached it the same way I would for appraising an apartment building. Really dove into the numbers and looked into individual like line items to see if they made sense, or if there's any room, like say each expense item, if there's any room to improve like efficiencies and reduce the cost, any room to capture more value, and then every income line as well. Is there any is there any other income streams we can add to this property? So yeah, let's looked at it with the appraisal eye. Yep.
Okay, good. Did you guys visit every unit in the 70 units too when you bought it?
Okay, big mistake. We did not. We did not.
It's
So,
hard, right? How do you do that? Like
yeah.
some syndicators and investors do not. Some even in Bay Area they do not. But some really good syndicators they actually do. Like I saw another friend. He goes, "Yeah, we're gonna do 255 units, 400 units, 500 units. We're gonna visit every single unit. We're gonna stay here for a month and make sure we hit every unit." I'm like, "Wow, it's crazy because you don't know what you don't know until you see it. So we're gonna see it because we're investing your money into it."
Yeah. Yep.
And then they find stuff. They're like, "Hey, all these stuff that the seller did not know because they didn't see it either, right? They didn't disclose. They didn't know."
Yeah. No,
So
definitely something I would do in the future too. That's another good point, a good lesson there. And I'm glad that it's syndication is always in the back of my mind, but I'm glad that we purchased this property with our own money.
exactly.
So we're actually learning all this at our expense and not at the investor's expense. So,
What did you find out when you didn't? What did you find out from not seeing all 70 units?
so there was a lot of heating units that went bad one year,
Okay.
and it was I don't know, $20,000-$30,000 worth of heaters, or maybe it was the manager, but yeah, these wall heaters were not working during the cold winters of Columbus. So it was like
Yeah.
an emergency situation where we had to get these fixed ASAP because it was, I don't know, like 10, 20 degrees over there.
Yeah. Cold.
Yeah, the manager would call. It's like, yeah, you have 2 heaters that aren't working. That it's going to be $1,400 each, and then we fix those, and then another next week there's three more that tenants that report their heaters aren't working.
Yeah.
I think during the time the property inspector for some of these heaters they weren't even able to turn them on for whatever reason. Maybe they were vacant units. Yeah, so it definitely was an oversight. That now we're going to make sure that every single unit we take inventory of every major mechanical system and condition of every unit in the future. That's something I'm definitely going to do instead of relying on the inspection company and
Yeah.
so,
I don't even know how long it would take for an inspection company to inspect 70 units one by one, like fully,
Yeah, they had a team of a few people going to different buildings, but yeah.
Yeah. And how thorough are they,
Right. Yeah. Yeah.
That's a challenge too, to see like, okay, great. It's nice to have inspectors do it. And I understand it, but at 70 units, how many people you need, how fast can you do it? And how good can you do it? And the reporting too, how many pages is that inspection report for 70 units,
Yeah. Yeah.
And then they're not using software to aggregate the data to give it to you as a reporting tool. They're just giving you a inspection file and you're going to have to go analyze the file.
Right.
So that's crazy too. I see some of those syndicators. What they do is they have applications and they walk around with their iPads. They go to every single unit and mark down the unit, mark down all the issues they see from themselves based on their experience, and they put it all in the reporting tool so they know exactly the whole building. And then they start analyzing the data, the cost analysis, and inspection reports based on it. And they start running numbers even during the due diligence phase so that they negotiate it with the seller and get a good credit back on the purchase. And like, that's good, but they spent the time to do it, a lot of work,
Yeah, no, it's definitely worthwhile to do that up front. And yeah, it's what they say, missing these things is costly. It really is costly, very costly. So
it can be. You win on the buys. You got to win on the buy and negotiate, especially on a multi-unit at this scale. You got to win on the buy and understand fully the building that you're getting into, because sellers they probably don't know, and it's not their fault. It's just because the building's so big and they haven't had the opportunity, or they didn't want to go visit every single unit of their own property, right?
Yeah,
So you get it. I think one thing I learned too is like, you always, especially when you have a building like your size, you want to check all the sewer laterals to figure out every single building in the flow to make sure it's actually performing, because the shit comes up,
Yeah.
You'll find it later, literally, right? You're like, oh, that makes sense. Who would think about looking at that in that specific way in this size, right? And for every unit.
Yeah.
But the cost already is, it's there. It's expensive.
Yeah. Yeah. One of the things that also got us on that was we're in a 1031 exchange. Both of us. My partner has sold his property first, so we were going by his deadline, and
yeah.
Yeah, so everything was very rushed. We closed probably, I think, the day of his deadline, his 6 month
Deadline.
deadline.
Okay, good. Kind of close, but I'm glad you guys closed on time.
And I should have mentioned to him too, as I know I'd read it before in the past. Like, don't let the seller know that you're in a 1031 exchange. You're gonna lower your negotiation power. Yeah, I shared that information. So like after we found all these issues and we tried to negotiate like a $200,000 reduction, they're like no, and then we're just like, okay. What do we do now? We can do eat the taxes, or we just gotta push forward. So.
That is true. And even though you need to know in the transaction just for the thing, there's other terminologies you can use, right? Like you can assign the rights, right? You never specify the assignment yet upfront.
Yeah.
But yeah, it's different. Commercial real estate versus the residential side is a little bit different there. But it's good. You guys, learning and being able to do it is a really good reason. And it's even how I met you too, because I saw you did a 70 unit. I saw you did Columbus, Ohio. I was like, hey, I want to talk to you about that, learn more, show our audience what's going on, how the market really works, how investing really works, how it's not just all fun and games. It's like struggle and challenges and humps you get through. But in the end of it, you still win, you still learn a lot, and you gain, and hopefully you gain equity and income from that. Cash flow, even with the headache involved,
Yeah.
So are you going to partner again with your friend to the next property? Because you guys are exchanging out, but you're going to exchange out together or exchange out separately?
We haven't decided yet. I guess it depends on the property we identify, if it fits both of our current criteria. Yeah, he might want to. He might have a different idea. Maybe he wants to do more cash flow. I want to do more value add. Maybe he has less time. Depends on the type of property and what's going to be the scope of work on that and what comes about. Yeah.
And, in the process of selling the property too, for example, since it's a big building, you guys are probably using commercial agent to do that. And then you have pro formas and hopefully you're still adding some skin in the game for the next buyer to buy into it. And then at the end of the day, you guys are still making money, right?
Yeah.
How do you guys come up with that valuation right now based on the current market with COVID and vacancy?
Well, I mean, the buyer of our property, as I understand it, they're not looking at our current performance. They're buying based on pro forma. They're coming in with their value add strategy. Okay. So they're really looking at market rents, and as long as the property has a vacancy or occupancy high enough where the lender will do the loan. It doesn't sound like our current performance matters as much. I think we did pretty well, and we're 85% collections.
That's good.
Yeah,
that's really good.
This area. So and again, it's a lot of it is because of that government agency help, right? So
that's good to have, because if you look at even in my syndications I'm in right now, some of them are LPs, but even then, even Class A's are 85% right now in collections. And I get it, but when you look at the pro forma, I was like, wow, this is going to be good in the next 5 years. And I could see why, even post COVID, I could see why we just got to deal with it during the whole time period to get there. And that's okay, but some of those are really nice Class A buildings, like cool. And then the B's and C's you see hit differently. The C's and D's, I don't even touch D's. You don't want C minus, you don't want D. It's just not. It's a lot of energy and effort to do it. Everyone wants to find a BC,
Yeah.
So that's good, but it's kind of nice that you guys are going to be able to take this chapter, go on to the next chapter, and and figure out like which state you're going to go into and how you're going to reinvest. And it's fun challenges in every way. I personally like multi-units more than commercial industrial, just because I think the vacancy factor for commercial and office space industrial is just way more complex, and the time it takes, even with triple nets and TIs, it's just so much vacancy and risk involved. I personally prefer multi-units because you have to live in a house, right? No matter what, you have to live somewhere. And there's a huge population growth throughout the next 10, 20 years. There's going to be more population. So over time, it will just keep increasing. But like you see, office space, you don't need office space. You have work from home now. You don't need retail space as much either, because no one's going to buy it. They're buying everything online, Amazon, right?
Yeah.
So those are different factors too. Industrial too is depending what kind of industrial you're looking at targeting to help, and how's that market doing? What happens tomorrow? They don't need it anymore. Like Tesla takes over everything, or Amazon, right?
Yeah, there's definitely probably not a good long-term play, but more of a quick like value add strategy, and very location specific. I mean, there has to be some proven demand in the area, and just and again, I'm looking at comparable sales every day, doing these commercial appraisals. Again, all property types, industrial, office, retail. I'm going to constantly look at these. So yeah, if there's a proven, one trend in here in Southern California, I don't know if you have it up in NorCal, but people were buying small office buildings, single tenant office buildings, and converting them to a creative office.
Okay,
And
nice.
yeah, they would purchase these for like maybe $200 a square foot, spend like $100 a square foot on the renovation, and end up selling like $450, $500 a square foot. Just these creative offices with these exposed beams, exposed AC ducts, that kind of thing. Yeah, so that was like a model in certain pockets of LA that I'd see investors doing. I'd see the original sales comp, and then like a year, 2 years later, I'd see the same sale again, and I'd see this explosion in value. Or sometimes I'd appraise these properties. So it gave me a lot of exposure to like what investors are like doing in these areas. So definitely, I think it's location specific and market specific. Yeah, calculated risk.
Yeah, I like your calculated risk because the fact that you, as an experienced appraiser, you can also see this and you get to see the appraisals anyways, and you can see what's going on and how they added value to the property. And especially you, because you're going into the buildings, you can learn a lot more faster and see how the direct areas, the direct properties, and how they're improving it. And you can find your own investments with that as well. And that's really nice to see. A part of this too is like, what are the main things you would tell a investor now buying to look out for and to invest in?
Investor to look out for.
Like, what issues should I be looking at if I want to invest today and I want to buy something in California, Pasadena, or out of state? What should they be aware of and some of the challenges?
Yeah. So yeah, I would ask that investor first, like what their goals are, because I have people approach me and they want to learn in investing, but it's just such a wide, such a like general question, like where do I start? So it's really, what type of investor are you? Are you seeking like cash flow? How much time do you have, like from your day job, if you have one? Do you have time to flip or whatever? And then after answering that question, then it's really your risk tolerance. So I mean, if we were to talk about, I don't know, if you're flipping or something like residential, that advice is going to be different. Now, I think you could do flips right now, and at least here in our market, and it's relatively safe. You might not been the same answer maybe like a year ago, like right at the beginning of COVID. If I were me, I probably wouldn't have flipped. But there's just so much like pent up demand now. If you flip, you're gonna make money right now. And I wouldn't do anything that would be like a value, like add on square footage, something that would take like a year or something to get like permits and get that all done. I'd do stuff that's like in and out real quick. So if you wanted to flip, things you could do like 3-4 months in and out real quick while the market isn't gonna like turn that quick. It's still relatively safe. If you're going out of state, go to the probably go to the red states, the states that have landlord friendly tenant laws. And yeah, it depends on what that specific investor wants to do. The type of advice I'd give them.
Okay. I think, yeah, and for me, the way I talk to investors is that, really when I look at property, whether it's California, Bay Area, or out of state, it's like, okay, investing. If you're going to do fix and flip, you got to think about multiple factors: price points, areas, taxation, capital gains on the short sale of the property, like you're selling quickly. And then another thing too is, how much are you buying the property for? Are you really getting it under market value? How are you getting it under market value? Because where are you getting the deal from? Wholesaler, agent? Is the agent going to give you the deal? Are you going to even win? Because in like Bay Area is multiple bids anyways. People are paying over asking. How are it's like hundreds of thousands over asking? How are you going to create the equity once you get the property? If you get it, how are you going to find contractors? Contractors are so busy right now, and it's so hard to get them involved. And if you get them, they're going to charge you a high price. How about permitting? With COVID going on, the permits can take multiple months. You can do cosmetic fixers and do that, and or do things unpermitted if you choose to. But hopefully, you're just doing cosmetic fixing, painting, refinishing some stuff, and cleaning it all up and making it nice landscape. How much value are you really adding? And at the end of the day, when you sell it, after all expenses and time, how much money did you really make after taxation too? Is
Yeah.
that worth your time? Or could you have done something else? Buy into a multi-unit, buy into a syndication, invest in stocks, invest in something, mutual funds, something else. What do you want to do, and what's your expertise at doing it? And do you have a team? The team is the most important part of it. A team of agents, investors, CPAs, lawyers, contractors, whatever you need to help you with your goal. Because if you don't have the four in mind, it's going to be really tough to do it. And doing it on your own as a single person, first time, it's a lot harder, right? But if you have a team, then it's easier to get done. And once you have an established team, you could just do it over and over and over again.
Yeah, yeah, no, that's a great point. Having a team and also having a mentor. I think that's what comes to mind now. I'm the type that I want to learn everything myself. It's like learn every single component, but it took a lot longer before I was able to start investing to get that comfort. But I think having like a mentor, someone who's done the same thing that you're trying to do, and someone you trust to walk you through that, you can just shortcut so much time, and yeah, you end up probably making more money in the end by paying someone to do that. Yeah.
I spoke to a lot of syndicators, investors out there, and they're like, for example, even in real estate sales, you talk about this. You can make 100%, but 100% of nothing, still nothing, right? I'd rather take 50% of something, and that something will turn into way more because I have the value of the investor, the mentor, the expertise, people who have done it many years. Instead of me spending 1, 2 years doing it myself, learning all the mistakes, I can accelerate it into 1 month, 3 months, 6 months, and do that. And they're going to show me and get rid of all the pain points to the best of their ability.
Yeah.
How much is that worth, right? That's probably worth more than the 50% you think about when, so having
Right.
something of a little bigger thing is great, like $1 million property, or you can go $10 million property, right? I get 50% of 10 million is better than 100% of 1 million.
Yep. Yeah.
So,
Time and speed. Yeah. They're looking back. It's like, but the more I was able to get 50% of something, but do more volume, I think I'd be much further along now.
yeah, and I think a good point is too, like even for my syndication, right? Like I started it 2 years ago. Even in the last 2 years, I haven't done much of it to get it fully up and running, right? Because there's so many unknowns. But now, like within the last 6 months to a year, I partnered up with a big time syndicator who's done a lot, like hundreds of units or over 700 units and over 70 million, right? How much faster is that going now, and how much more stability you have, and how much more strategic alliances he has with a huge network throughout the country, and to find deals that you would never find as a one-off investor syndicator. You're never gonna get access to all these deals. They're gone. And those big syndicators they partner with have 6,000 units, 12,000 units, things you'll never even hear of. And to have access to that will help your clientele base invest more and have a better performance and trusted network, right, to support you.
Yeah.
That's worth its weight in gold, right?
Yeah, for sure. I'd agree. There's a lot of sometimes we get caught up on the short term cost of something. We're really not seeing all the intangible benefits of, like you said, working with someone here, and there's just all these additional things we're not factoring in because we're caught up with the money. Yeah.
So going back before we wrap up, I wanted to ask you another question about appraisals and valuation. How do you see the market right now with property values and people? For example, I know you do commercial, but for example, just looking at the space in general, how do you see the economic market changing in California, and like how are people when they're buying these homes? The appraisals can't justify because it's historically, yeah, the price is this value, but right now in the current market today, not yesterday, today, the prices are shooting up because there's so limited inventory. So how do people deal with that in terms of like, buying property, multi-units, or even single family homes? How do they handle that valuation part of it?
With regards to the single family market, I think you just can't apply logic right now in this market. We'll be working with the buyer and trying to determine what offer price to submit on a single family home, and I'll look at the comps, and this has happened like over and over in the past like year or so. I'll think that the price should be this much based on the comps, and even adding a little premium for that, and then we end up losing the offer, and I'll see the property eventually sells, and it ends up selling like tens of thousands of dollars more than what I had calculated. There's just this, it's, you can't apply logic because there's a lot of emotion involved in buying like a single family home, and people, they're not looking, these same buyers are not looking at the comps and like, I want to pay like this much. Like when you want it, you want it. So yeah, for a buyer, I would just really like ask you, like, how much do you love this home? You're gonna overpay. Like right now, you're just, unless you get lucky, you find something off market, you're gonna overpay, and you have to be okay with that. Like, do you love this home enough to buy that? You can't apply logic right now. You can't think like, oh, I don't want to pay this much in this market right now. If it's either you love the home enough to do that, and you have the motivation to get into a home now, or you don't.
Very true. Very true. I tell that to our clients too, like, hey, this is what it is. But at the same time, one thing we try to do is like, we try to give them some future, not predictions, future forecast analysis of what we think will happen, unguaranteed 100%. Just like, hey, this is a great area. I know you're overpaying right now, but if you look at it, all the area around your home, it has really great homes. And if you look at the age group of these homes, people are going to start turning. And when these turn, these bigger houses are going to add more value. These multi-units, because of this price range, the rentals will go up in the next X years because of this and this and this factor, unguaranteed. But that helps kind of feel comfortable. Okay, I am paying a little higher price. I'm not paying crazy, but at the same time, I can see the forecast of what might happen, and it makes sense. I'll take the calculator risk myself to do it as a buyer, and then they're happy with it. But if you're overpaying number one property and the area is all down, you really know you're gonna lose on that one, right? You can kind of see that.
Yeah.
Okay, cool. Other than that, about to wrap it up. I really appreciate you being on the show and sharing your expertise and knowledge, going from single families, multi-units, fix and flips to 70 units and maybe back. But it's kind of cool to see from your investing appraisal eye and an agent eye how you have done it. And I'm glad you're sharing this to the community. Hopefully they reach out to you. You're in Pasadena, but you help clients everywhere, right?
Mm-hmm.
And reach out to you, ask you any questions about it, and hopefully look on to future investments and journeys, and maybe even JV partnerships on deals that make sense, that we can learn from each other.
Yeah. Thank you so much for having me, Matthew. It's been fun.
I'm glad it went fast. It's an hour now. It went really quick.
Yeah.
So everyone, reach out to James Tran. You see his email right here, james.tran@jtrei.com. For any questions on real estate investing, California or out of state, ask him about that. And if you have any deals for him, send it his way, send it my way. Happy to talk about that. See you guys on the next one. Thanks for joining us at the Truth About Real Estate podcast, and we'll see you in the next one. Have a great day.
See ya.